Welcome back to accounting. Today we're going to look at an installment note, which is basically a note that you borrow, which you make payments on either annually, quarterly, or monthly. Most of us are very familiar with installment notes. If you've ever had a car loan, for example, that's an installment note. You purchase the car and you finance it, then every month you make a payment on that car. Or you may have heard your parents or someone else, or maybe even you, have a mortgage on your house. Those are examples of installment notes. And I think they're very important because most everybody in society at some point will have to deal with an installment note. So that's the first thing we're going to look at. We're going to look at an installment note with an annual payment. Those aren't as common in our personal lives as they may be in business world, but in our personal lives, normally we deal with monthly installment payments. So let's look at this. On January 1st, 2021, Let Us Eat Sandwich Bar borrowed $90,000 for 4 years at 5% interest. The loan requires 4 annual payments of $25,381. We are rounding computations on this problem to the whole dollar. Now, in the real world, we wouldn't, but in this one, we will. So when we look at that, excuse me. So when we look at this, let's see, how did they get that payment? Well, I've got a little Excel spreadsheet that I use quite often. We borrow 94 years at 5%. So we're borrowing 90,000 at 4% for 5 years. And our payment is annual. Let me make sure I've got all the information there. It's 4 years at 5%. I'm backwards. It's 5% at 4 years. There we go. So what I build in Excel is sort of just a quick way where I can amortize information, and you can see it to the penny. If you build one of these, you can build this in Excel, and it will tell you anytime you go to borrow money, how much it's going to cost you over time. So let's just talk about this loan for a little bit. We're borrowing $90,000 for 5%. Now that is an annual interest rate, just like if you buy a car or a house. Those are annual percentage rates that you're paying. And then the terms is how many years the bond will pay, or excuse me, the note will last until it fully is paid off. So this one's going to be a 4-year. Now notice the number of payments here, it's 4 payments. That's because it's annual. If this were monthly, we could go in and type monthly and it would tell us that, hey, that's 48 payments over those 4 years and it would cost you $2,000 per month. So a little bit different in that respect. It's sort of neat that you can build it to do that. So we're going back to our annual example here. There's 1 payment per year, so there's 4 total payments. So in Excel, you can use the payment function. So if you want to learn how to do this, let me pull this down just a little bit so you can see that. There we go. If you want to learn how to do this, this is the formula that you would use. You can pause it, open up a little spreadsheet to the side and replicate. I highly recommend you do that. At least for some of the features. Now, some of this may get a little technical, so we're not going to show you everything, but that's one of the options, the payment function. And you can use that in Excel. It's quite handy because it will show you the payment on any note that you want to borrow. So in other words, say you want to finance $300,000 for a house, and the rates right now are about 3.5%, 4%, and that's going to be for 30 years. Now in that 30 years, there we go. Now our payment's not going to be annual. On a mortgage, you would have a monthly payment. So that's 360 payments. That would be a mortgage payment of $1,432.25 per month. Now here's what I want you to see though. Look over here. The total cost of that $300,000 loan is $515,000. You pay $215,000 in interest over the life of that mortgage. Now what if we broke it down to 15 years? Well, notice our payment did go up quite a bit each month, but notice how much our interest is, $99. How much did it save you? $215 versus $99. We're saving over $100,000 in interest just by dropping the mortgage down. So I highly recommend you try and build one of these in Excel. Over here, these functions are a little bit different because we have to index based on how many payments there are, because it has to be able to go to the term where it's actually due. So notice I've got some weird formulas in here to make that happen, because what happens, well, let's go back to our example, 9 years, or excuse me, 90,000 at a 5 rate for 4 years. And this was annual payment. Notice after 4 payments, your balance is 0. So this has to be able to know where to stop adding and looking at the data. So in this note, we're only going to spend 11,000 of those years. So if you want to build this in Excel, please try your payment formulas there. This just equals the payment. Your interest is always going to be your principal times your rate times your time. So your principal, 90,000, your carry value, times your rate, 5%, times payments per year. So you've got to divide that because your rate there, this is where you get the divided by 6 out of 12 or 12 out of 12, whatever, because there's one payment per year. So it's going to divide that by 1 instead of breaking it down to 12 equal payments. That would give you your interest. Your decrease in carry value, of course, is simple. That's just going to be the difference between the interest and the cash paid. And then last is your new carry value, the amount you owe on the note. That's the 90 minus what you decreased your carry value for. So you can build these in Excel and quite easily, but the important part, that's our payment, $25,381. So now let's go in and look exactly how we would do this in journal form. So first and foremost, how do we create that amortization chart manually? Well, again, at the beginning, you're not going to want to use these first 2 cells. To start, you're going to put the amount that you borrowed, 90,000. Just like we did in Excel here, we started at 90,000. Now our answer will be a little bit different because we're going to round to the whole dollar. We're going to drop this 6 cents just because it's 6 cents. It's crazy, so I don't want to have to deal with that during this whole problem. So we're going to lose the decimals for now. All right, so it's going to be 25,381. Now, how do we get interest expense? Well, it's principal times rate times time. So we're going to take the 90,000. So really quick, I'll just put it right here. We're going to take 90,000 times a rate, and the rate is 5% times time. And the time is how many months out of the year have passed. Well, in this case, it's an annual payment, so it's going to be 12 out of 12. Because the payment is due on December 31st, 12 months have passed, so we've accrued 12 months of interest. So 90,000 times 5% times 12 twelfths. So in other words, excuse me, just simply take your 90,000 and multiply it by that 5%. That'll be the easiest way to do it. And that gives us $4,500. So that's our interest expense. Again, if we go over here, notice that's the exact same number they get there because 90,000. We haven't rounded yet really for that. Now this is going to be the difference. It's going to be the 25 minus the 4. So the same way, we're going to take the 25,381. We're going to subtract the 4,500, and we get 20,881. Now what's the new carry value? Well, your carry value is going to be the old carry value minus the decrease, the amount that goes toward principal. So we're going to take that 20,881 away from that 90, and we get 69,119. Now to keep the cycle going, the payment will be the same every single time. Your monthly payment is pretty consistent. How much in interest? Well, now take the 69,119. So we're going to go back up here now at 69,119. We're going to multiply that by the 5% because it's the annual payment. We get 3,456 rounded. Then take 25,381 minus the 3,456, and that's going to give us 21,925. Now notice we'll be a little bit different now because they've rounded. Okay, so they've got 95 cents and 12 cents. So we've rounded to the whole dollar. It's a little change or departure. Then we're going to take that 21,925. We're going to subtract the 69,119. We're going to get 47,194. Quick check. 47,194. We're right there. We've rounded. We're a little different, but we're good. All right. Now take that 47,194 times the 5%. You get 2360. 25,381 minus 2360, or excuse me. Yeah, 2360 gives me 23,021. And subtract that from the 47, and we get 24,173. Gee, bam. Notice we're just a little bit off 60 some odd cents. Now in the last year we have to be careful because this number right here has to be 24,173. There's only 4 payments, so when we make this last payment, guess how much we owe? We owe 0. So on this very last one, just be really careful to make sure, since we've rounded, that it comes out nice and neat. So we should get, let's see, 1209. And let's double check to make sure that that balances out. 25,381 minus 1209 gives me 24. So notice I'm just a little bit off. So how much do I need? Well, 25,381 minus the 24,173. I need 21 or 1208, excuse me. So notice how I was $1 off when my rounding there, simply because we've rounded. So make sure that we end up at 0, because once you fully amortize a note, you will owe nothing on it. An installment note pays both the principal and the interest each period. So even though we are making an interest payment, we also reduce the amount we owe. Okay? All right, now how do we journalize this? Well, let's start with the beginning, the loan inception. So here we borrowed $90,000. We didn't buy anything with it, so our asset here on January 1st would be cash because we borrowed money. Now, if you bought a car, you would hit your car account or whatever. But we borrowed 90, and we would credit our notes payable. Or sometimes you'll see an installment notes payable, so people remember that it's an installment. Now, what's the difference between an installment note and a mortgage? A mortgage actually is secure, so your house secures the mortgage. Your car is actually a mortgage. You've mortgaged your car. We just don't call them those in society. We reserve mortgages for houses. But that's the secure debt would be mortgage. You mortgaged your vehicle, so to speak. We just don't talk that way in society. All right, what would be our first payment on December 31st of 21? Well, just like before, our interest expense, we're actually going to journalize these three columns. Okay? So let's highlight those a little bit. These three columns are your journal. Interest expense, expenses are debit, so you're going to debit the interest expense. You're going to credit cash, and you're going to debit the actual note. Okay? In an installment note, as we make payments, we actually do reduce the amount we owe. So we're going to hit our interest expense. We're going to decrease the value of our notes payable, and we're going to pay that out in cash. And again, follow through. $4,500 would be our interest expense. Our note payable would be $20,881, and then $25,381 would be the cash payment. Now we could journalize the rest of this. We could just keep going because every single payment would be the exact same entry. The only difference would be the split between interest and carry value, okay? Or notes payable, excuse me. Why is that? Well, as the balance goes down, our interest expense will decline over time. So the total amount of expense on this is going to cost us $11,000 right at in interest, $11,520 some odd dollars. If you add this column up, that'll tell you how much in total interest that you'll pay on this note. Okay? All right, so hopefully this is a little bit better understanding of how to journalize. We're going to look at what happens if it's a monthly payment in our next video. Hope you all have a wonderful day.